So when you are reading a different standard and then you come across fair value, now what do? You have to go back to IFRS 13 and look for the meaning of fair value and how to determine or account for fair value of that asset or liability. So you realize that IFRS 13 is not an isolated standard, but rather it is used as a complement to other standards, right? It's not used alone. So you are reading a different standard, you come across fair value. You have to come to IFRS 13 and look for what ways of measuring or determining the fair value. All right. So that's it with IFRS 13 fair value measurement. So this is CN Professional Institute. And in this video, we'll be delving into IFRS 13 fair value measurement. So let's start. What is fair value? So fair value is defined as the price that will be received to sell an asset, right? Or paid to transfer a liability in an orderly transaction between market participants at the measurement date and the current market condition. So when we talk of fair value, it's not anything difficult. It's just the amount you receive or the amount that will be received to sell an asset or paid transfer liability. So now you have your land, your building, whatever you want to sell. All right. Now, if you take it to the market, how much will you receive from selling the asset? That's the fair value. Right. What you have to know is that fair value is determined from what? The perspective of the market. So it is the amount that that will be charged to sell an asset between market participants, between participants that are independent. So the word is what? Independent. Why independent? Yes, you see, for us to get the true fair value, okay, the transaction should happen between two independent people. If the parties are related, okay, like your friend, your mother, your father, your relative, you see, you might not sell the asset at what? The exact price, or you might not sell it at the arm's length, right? I mean, because you are related to the person, you might sell at a lower price, right? And that might not reflect the fair value. So fair value happens between what? Independent parties, okay, in an arm's length transaction. So don't forget that. So the question is, if the two parties do not know each other, how much would they charge? You see, that's fair value because it's going to reflect the amount that the market, okay, or the amount that will be obtained from the market, right? So don't forget that fair value is determined, or we determine the fair value using independent parties, parties that are not related to each other, so that we don't want the price to be what affected. We want to get a true fair value. All right. So that's it. It's the amount you receive to sell an asset or paid transfer liability. Now, liability can be transferred, right? Liability can be transferred from one party to what? Another. Now, people ask, how do you transfer a liability? All right. Yeah. How is liability transferred? So, how do you transfer a liability? Now, let me give you an example. Let's say a mining company has an obligation to restore a particular land after mining operations. All right, maybe they are doing mining decommission. They are doing mining, so after mining, they have to, restore the site to their original form. Now, let's say it will cost them an amount in the future to do this. What they can do is that they can transfer that liability to somebody else. They can transfer the liability, transfer it to maybe a different firm. Let's say a specialized environmental service firm. So they can transfer the liability to that firm so that they do not do what? The restoration or the decommission in the future. They can transfer it. So they can pay 5 million to this specialized environmental service firm, so that in the future, the specialized environmental service firm will do what? The restoration or will do the decommissioning. You see, in that case, they've transferred the liability. So they will not be responsible for the decommission again. They have transferred the what? The liability. All right. and this amount they are paying the what, the specialized environmental service firm. So what it means is that they have transferred the liability. Yes. How much did they pay to transfer the liability? They've paid 5 million Ghana cedis to transfer the liability, and therefore the fair value of the liability is what, 5 million, right? Why is 5 million the fair value of the liability? Because under IFRS 13, the 5 million represents the fair value of the liability because it is the price paid to transfer the liability, okay, to a different market participant. So that is fair value. It is the amount that we are going to receive to sell an asset or paid to transfer a liability, right? And I said it should be between independent parties in an arm's length transaction. So if you look at the definition, we have this in the definition, the asset or liability is there in the definition. Where is it? We have, yeah, we have the asset or liability in the definition. Okay, yeah. Then we have the transaction to here. We have market participants here. And then we have the price, which is here. So normally the price and exit price. Why is the exit price? Because it's the amount you receive to sell. So you are leaving the market. If you sell something, you are leaving the market. That's why it's an exit price. We'll look at more into details, right? All right, let's continue. So before we continue, you have to look at this. This is the scope. IFRS applies to, it applies when another standard requires or permits what fair value. That's why I said from the beginning that if you are reading the standard and you come across fair value, all right, you are reading the standard and you come across fair value, you have to come to IFRS 13. So we use it when another standard permits it. Now, it does not include the following. So IFRS 13 doesn't apply to these standards. It doesn't apply to share-based payments under IFRS 2. All right. It doesn't apply to share-based payment under IFRS 2. It doesn't apply to leasing transactions within the scope of what? IFRS 16, right? Leases. Then it certainly does not also apply to inventories. You know, inventories are measured subsequently at the lower of cost and what? Net realizable value. And you know, NRV is not the same as what? Fair value. So these standards are there. We will look at them in details. I have videos on them so you can check them out, right? Then it also doesn't apply to what? Impairment of assets, IAS 36. IAS 36. You know, to get impairment, we compare the current value with the recoverable what amount. And the recoverable amount is the higher of value in use and fair value less cost to sell. So we are saying, what we are saying is that fair value doesn't apply to this standard. Just let's cut it short here. All right. We, as I said again, these standards are there, videos on them, you can check them out, right? Then we have planned assets measured at fair value, okay, under IES, IS 19 employee benefits. I have videos on employee benefits too, very detailed one, so you can also check that one out, right? So these fall outside the scope of IFRS 13. It means fair value doesn't apply to these standards, so watch out. Now let's continue. So in the definition, we said that we have assets in the definition or the liability. So we are saying that when measuring the fair value, you should take into account the characteristics, right, of the asset or the or liability. If market participants would take those characteristics into account when pricing the asset or the liability at the measurement date. Examples of such characteristics include the following. So we look at the condition and then the location and about the restriction. If I'm measuring fair value, right, the asset whose fair value you are determining, you have to look at the characteristics of the asset. I mean, characteristics can affect the fair value. For example, you want to determine the fair value of an asset. I mean, you have to look at the age of the asset. You have to look at the level of wear and tear. That's the level of depreciation, the remaining life of the asset, right? Whether it's damaged or not. So we look at all these things. You also have to look at the location, because location can affect what the transportation cost. It can affect accessibility. All right. So location is also there because you realize that let's say a price of maybe land in a city may have or a land in a city may have a different fair value or higher price than the one in the village, maybe because of stronger demand and a lower access cost, all those stuff. So we look at the location of the asset too. We look at the restriction. Okay. Um, sometimes we have something called the zoning laws. Some zoning laws they limit the use of the asset, or is there any legal restriction? There are some areas where you can put up, let's say, factory or stuff, right? So we look at all these things. Is there any restriction on the use of the asset? And why do we factor in? Because all this can affect what the fair value of the asset, right? Okay. Then, still on the asset, we are also saying that you can determine the fair value of the asset either as a standalone or as a group of assets, right? So you can determine the fair value of an asset or liability as a standalone. Example, PP, you can determine the fair value of maybe a particular land, particular building. You are doing it alone, or you can do it as a group. So we can have a group of assets, group of liabilities, or a group of assets and liabilities. Example, cash generating units. So cash generating units, we've looked at that in IAS 36, right? IAS 36, impairment of assets. All right, we looked at it in IAS 36, impairment. So we have cash generating units and CGUs. Sometimes you can just put them together and determine their fair value. And this is what we call the unit of account. So what we are saying is that for assets or liabilities, we can determine the fair value either as standalone, meaning can determine the fair value individually, or as what? A group. All right. And that's what we call the unit of what? Account. So unit of account refers to the level at which an asset or a liability, okay, is aggregated. Aggregated means you are putting it together, or disaggregated. You are what? Separating it. Okay, in an IFRS for recognition purposes. So the unit of account for an asset, or for the asset or liability, must be determined in accordance with what the IFRS that requires or permits fair value measurement. So what we are saying is that for assets, we can either find the fair value alone, right? For asset or liabilities, or for some assets or liabilities, you can either determine the fair value alone, as a standalone, or we can do it as what? A group. Okay. And that's what we call the unit of what? Account. All right, let's continue. Now, we are still looking at the key elements in the definition. So one key element in the definition is what we call the transaction or the market. It's also in the definition. So we're just looking at the elements in the what? The definition, right? We are looking at the elements in the definition, right? Now, the definition also mentions what? Transaction or what? Market, right? So if you come here, it says fair value is the price that will be received to sell an asset or pay transfer liability in an orderly transaction between market participants at the measurement date. So you mentioned the market or the transaction. Now, under IFRS 13, right? Fair value. IFRS 13, fair value. We have two markets. Okay, so if you want to determine the fair value, you have two markets. We have the principal market and the most advantageous market. Don't forget that. We have one, the principal market, and two, the most advantageous market. So we have the principal market, also called the active market. Okay, the principal or the active market, and then we have the most advantageous market. So this is the principal market, and this is the most advantageous market. So IFRS 13 gives us two markets from which we can determine the fair value. Now listen carefully to the rule. IFRS 13 says whenever I want to determine the fair value, we should always use the principal market. I said we should always use what? The principal market or the active market. The principal or what? the active market. That's what you always use. If there is no principal or active market, then you can go and use the most advantageous. So that's the hierarchy. We give preference to the principal or the active market. And in the absence, if there's no principal or active market, then essentially we should use the most advantageous market. So don't forget the hierarchy, active or principal market first. If there's no active or principal market, then we use the most advantageous market. So that's it. So we determine fair value using the principal market, and in the absence of the principal market, the most advantageous market. Now, what do we mean by the principal market, and what do we mean by the most advantageous market? So let's look at an illustration, or let's explain it in detail. So let me split my screen, and then we can look at it in details, principal market and most advantageous market. All right, so let's continue. So we said that the standard says whenever we want to determine fair value, we should use the principal market. If there's no principal market, then we can use the most advantageous market. If there's no principal, we can use the most advantageous. So now the question is, what is the principal market? Now the principal market is the market with the greatest volume of activity for the asset or the liability being measured. Now what do you mean by market with the greatest volume of activity? This is an example. Let's say we have two markets, market A, market B. In market A, okay, let's say we can sell 20,000 units. Let me change my pen color so that I can write better. In market B, we can sell 40,000 units. Now, in this case, market B is what we call what? The principal market. Why? It is the market in which we can sell the greatest unit. It's the market in which the largest quantity can be sold. It's the market that absorbs the greatest unit. So that's how we determine the principal market. Very simple. Use quantities. Okay, so we use what? Quantities. So go to the market and ask yourself, okay, in a particular day, in a particular month, how many units can be sold on this market? How many units can be sold on this market? How many units can be sold on this market? The market in which we can sell the greatest units, okay, or greater units, is the principal market. It's very simple. So in this question here, I said B is what? The principal market, because it's the market that we can sell the greatest unit. So have it in mind. Principal market uses quantities. Again, quantities. I'm saying it's very important. Principal market uses quantities. We don't look at prices. The market that can give us the highest price, no. We look at the market in which we can sell more. So you have two markets. You have, let's say, Makola market. You have KGTR market, Tudu market. In which market can you sell the greatest unit of that quantity? I'm sorry, of that item, of that asset. Okay, so the market in which you can sell the greatest unit, that market becomes the principal market or the active market. So I'm done. All right. So yeah, so that's it. Then we have the second one, the most advantageous. This is if there's no principal market, then the fair value is measured by reference to what? The most advantageous market. So I told you the standard says we should only use the principal. It's when there's no principal that we go and use what? The most advantageous market. So now let's look at what most advantageous market is. We now know what the principal market is. Now, what is the most advantageous market? The most advantageous market is the market that maximizes the amount that will be received to sell the asset, or minimizes the amount that will be paid to transfer the liability after taking into account transport cost and transaction cost. So we are done with the principal market. Let's look at the most advantageous market. So with the most advantageous market, let me write it, most advantageous market, which we normally call it the MAM. most advantageous market. So with the most advantageous markets, we don't use quantities, but we look at the markets. Okay, that will give us the highest net amount in monetary terms after we have deducted our transport cost and transaction cost. So with the most advantageous market, we don't look at the market in which we can sell greatest units or greater quantities. No, we look at the market and compare the one that, okay, if we sell in this market, we are going to get more money in quotes, or yes, more money after we have deducted our transport cost and then what transport cost and what transaction cost. So what you do is that, okay, let's say we have the same two markets, market A, market what B, right? Now let me wipe this one here and take it to this side. So here to the same, we have two markets, market A, market what B. All right. Now let's say for um for market A, selling price is 40,000 Ghana cedis. Market B, selling price is what 80,000 Ghana cedis. Transportation here is, let's say, 5,000 to the market. Transportation here is what, let's say 10,000. Then transaction cost is, let's say 1,000 here and then 30,000 here. So these are random figures I'm looking at, so don't worry. Now they are all in monetary terms, right? CD or dollar. Now what net amount will you receive if you deduct your transport cost and the transaction cost from the selling price? Are you following? So here 40,000 minus 5,000 minus what? 1,000. Are you following? So just know that with the most advantageous market, we don't use quantities. We use we use the market that will give us the highest or a higher net amount. Okay, after we have deducted the transport cost and transaction from what the selling price. So you have to pick your selling price and less transport cost and transportation less transport cost and transaction from what the selling price, and then the one that will give you the higher or the highest becomes what the most advantageous market, right? Okay, so you see that this will give us what 34,000. Hope you are following. Then here we have 80,000. Transport is 10,000. Transaction is what 30,000. So what do we get here? You get what 40,000. Are you following? So don't forget we are lessing the transport and what the transaction cost. So this is a net amount we are going to receive, and it is in what? Let's say Ghana cedis or whichever currency it is. So you see, if you compare the two, which one is the most advantageous? Right. So realize that the most advantageous market, abbreviated MOM, is what? Market B. Why is the market B? Because it gives us the greater what figure? 40,000. I hope you are following. So this is how we determine the most advantageous market. Most advantageous market uses what we call it uses money, it uses monetary values, it uses selling price, then you less transport transaction, then you compare the one with the highest or a higher net figure becomes your most advantageous market. We'll solve plenty questions. I have so many questions that I'll be solving. So please just stick to this and then stay with me. Now, so that's what we have here. It says transport and transaction costs are taken into consideration when that's exactly what we did, right? That is exactly what we did. We deducted the transport and transaction cost from the selling price, and then we compared the one with the higher or the highest is the most advantageous. That's what we did. You know what transport cost is? Cost that will be carried. I'm sorry, this is transaction. You know what transaction cost is? It's just any cost that we are going to incur to sell the asset, okay, or transfer the liability. So cost to sell the asset or liability in either the most advantageous or the principal market. Okay, that's what we call the transaction cost. An example is legal fees and broker fees. For example, if you are selling shares and blah blah blah, sometimes you need to get brokers to do it for you. So the amount you pay them is part of what the transaction cost. All right. So don't forget that. Don't forget the transport cost and the transaction cost. So transport is cost incurred to carry the asset to the market, right? To transport the asset from its current location to the market, either the most advantageous or the principal market. All right. So that's it with the most advantageous market. It is the market that maximizes the amount that we are going to receive to sell the asset. If it's a liability, that will minimize after you've taken into account transport and transaction cost. Okay, so as I said, just pick the asset, or let me say, pick the selling prices. Okay, pick the selling prices, deduct all transport costs, deduct all transaction costs, and compare the one with the highest or the higher net amount in monetary terms becomes the most advantageous market. So we've learned how to determine the principal market. The principal market uses quantities, not money, or not monetary figures. Most advantageous uses monetary figures, not quantities. And with the standard says we should always use the principal market. It's when there's no principal that we use the most advantageous market. Now, we've looked at that. Let's look at what market participants are, and then we'll come back to something here. So let's look at this. So let's continue. So market participants. Market participants, they are just the buyers and sellers. That's all. When you say market participants, buyers and sellers. So you and I, we are market participants because you go to the market either to go and buy or to go and sell. So we are market what? Participants, one way or the other, right? So a market participant is the buyer or seller in either the most advantageous market or the principal market for the asset or the liability, all right? And then these are the features of what the market participants. They are independent. I told you, well, that's one key thing. They should be what? Independent. Because if they are dependent, we might not get the true fair value. If they are dependent, we might not get the true fair value. Because if you are selling something to somebody you are related to, you might not really get the true fair value, right? So they are independent of each other, meaning they are not related parties. They are not family members, they are not brothers, they are not sisters, they are not, they are what? Are not related. They are knowledgeable. They have an idea of what's going on the market. They have a reasonable understanding about the asset. So if you want to buy a mobile phone, you have a fair idea of the price, at least the range. Yes. If you don't have the idea, you might be exploited. People can cheat on you and then do that, right? Whatever sort of stuff to you. So the market participants, they are knowledgeable. Before you buy something, and I'm sure most of us we have the idea. You're going to buy a laptop, you want to buy whatever your planned equipment, there's an idea, a reasonable understanding of the asset, right? So we see market participants are knowledgeable of the asset that they're buying, all right, or of the liability that they are transferring, and they are able, and they are also what willing. So it means that they are not forced, but they are motivated. So these are features of what market participants. Per Ifrs 13, they are independent, they are knowledgeable, they are able to enter into the transaction, and then they are willing to enter into the transaction. And then lastly, we have this one here, which says the entry price and then the exit price. Now, what's the difference between entry price and exit price? Exit price is the amount that you receive to sell the asset. So you are leaving the market, that's why it is exit. If you sell something, you are leaving. That's why it is what? Exit. So exit price is what? The price that you receive to sell the asset. You're selling the asset, so you are leaving. Or you are paying to transfer the liability. So the amount that you are paying to transfer the liability is the exit price. Okay. And then with the entry price, the price that you are paying to acquire the asset. So if you are buying the asset, you are entering the market. So you are buying the asset. You have the asset now. So it's entry price. So entry price is the price that you pay to acquire the asset, or you receive to assume the liability. Sometimes you can either transfer liability or you assume it. If you remember the example I gave you, where the mining company transferred their decommissioning obligations to the environmental firm. Okay, they pay the environmental firm, so they are leaving the market. So it's an exit price. All right. The environmental firm is now assuming the liability, so they are receiving. So to them, it will be an entry price. So the price paid by the mining firm to the environmental firm, to the mining firm, they are paying. So it's an exit price. Okay, because they are transferring the liability and they are paying that amount to transfer the liability. So guess it, with the exit price for assets, it is the amount that you receive to sell the asset. You are exiting, so you are receiving this amount to sell the asset. For liability is the amount that you are paying to transfer the liability. Okay, you are leaving the market, so that's what entry, and sorry, that's exit price. That's exit. Then entry for asset, you are buying the asset, so the amount that you pay to acquire the asset. For liability is the amount that you receive to assume the liability. That's the entry price. So that's it. And you realize that IFRS 13 uses what? Exit price. Don't forget. Why did I write? I wrote exit and don't mind me, okay? It's exit price. Now, why is IFRS 13 using exit price? Because if you look at the definition, it says it's the price that will be received to sell the asset or paid to transfer liability. So it's perfectly an exit price. So don't forget that. We use exit prices. So you can see a question where you have a mixture of exit and entry prices. You have to know which one we use to determine the fair value. We use the exit price. There's a question on this where we have so many prices. So you have to figure out which one we are going to use, and then we'll solve all those questions. All right, I have plenty of questions that will be solving on IFRS 13. So as I said, once again, I would advise you watch all for you to really understand fair value very, very well. All right. So that's it. And then it says orderly transaction. A transaction that assumes exposure to the market for a period before the measurement date to allow for marketing activities that are usual and what customary for transactions involving such assets or liabilities. It is not a forced transaction. Example, a forced liquidation or forced distress sale, all right, or distress sale, forced liquidation or distress sale. So yes, we said the transaction should be orderly. It should not be a forced something, all right. So let's pause here. But before that, let me give you the formula for fair value. So to determine fair value is selling price minus transport cost. So that's the formula. So you can put it down neatly. This is the formula I'll be using. The selling price minus transport cost. Now, what you have to know that when we're determining the most advantageous market, if you remember what did we do? We picked the selling price with less transport cost and with less what transaction cost. You see, up you've seen the two now. To get the most advantageous market, you just pick your selling price, less your transport cost and less the transaction. Then we said you compare the two, the one with the higher figure becomes the most advantageous. So you see, most advantageous market takes into account both transport cost and transaction cost. But fair value takes into account only transport cost. Very, very key. That's why I'm writing this. This is the final thing I'm writing because I want you to stick in your head. Fair value is selling price minus transport cost. Whilst to determine the most advantageous market, we let both transport and transaction cost. Don't forget that because we are going to use this and we'll be using this in our computations, right? So that's why when you come to when you come to this side here, where you come here, it says that if location is a characteristic of what the asset, the price in the principal or the most advantageous market is adjusted, okay, for the cost that will be incurred to transport the asset from its current location to the market. So we are saying if transportation or if location is the characteristic of the asset, then we have to consider or we have to factor in what transportation cost if you are determining the fair value. You have the asset in the northern region. Now, if you want to sell in Accra, you have to transport the asset from the northern region to Accra. So we are saying if location is a characteristic or a feature of the asset, as a feature of the asset, in determining the fair value, you have to deduct. Okay, you have to deduct what transport cost. That is all. That's why fair value is equal to selling price minus transport cost. Selling price minus transport cost. But if you come here, there's a transaction cost here. Yeah, it's not what adjusted for. So transaction cost is not adjusted for. So if you are determining fair value, we don't adjust for it. We don't adjust for transaction. That's why fair value is only selling price minus transport cost, not selling price minus transport minus transaction. But if you are determining the most advantageous, for that one you factor in both transport and transaction. But for fair value, if you want to determine the fair value, the formula, it's only selling price minus transport cost. So guys, let's end here. All right, we are going to continue. So let's end part 1 here. We're going to continue with part 2 of Ifrs 13 fair value. In part 2, we are going to solve more questions. We are going to solve like we'll be solving like 10 questions in all. No, yeah, 10 questions on fair value, but or more, yeah, can be more. But we are going to look at how we calculate fair value of an asset. Then we'll proceed and look at what we call, there's something called the highest and best use. So how do we apply fair value to non-financial assets, right? We will look at this in the subsequent videos. So I'll see you in the next video.